Good morning to our viewers here in the United States. Good afternoon to our viewers in Europe, and happy Friday to everybody. Thank you for joining us for today's discussion about sustainable finance. Last month, Germany's Sustainable Finance Committee released a report outlining more than 30 policy recommendations to be taken to establish a sustainable finance system. The report was just released in English, and we will post a link to the Sustainable Finance Committee in the chat, where you can also find that report in both languages. To talk to us today about sustainable finance in Germany and the United States, we are joined by Dr. Gerald Podobnik. He is the CFO of the Corporate Bank Division of Deutsche Bank and also has various sustainable finance responsibilities within the bank. He is the co-chair of the Group-wide Sustainability Council and serves as the head of ESG business for the Corporate Bank Division. Since its creation in 2019, Gerald has also been a member of the Sustainable Finance Committee. This committee advises the German federal government on the development and implementation of its sustainable finance strategy. Herzlich willkommen.
Dankeschön. Thank you.
We are delighted to have you with us today, Gerald. And so let me maybe briefly set the stage and then turn the floor over to you. Digitalization, globalization, climate concerns, and more recently, the coronavirus pandemic are driving change around the world. In order to address these trends, companies must innovate and adapt to survive. And the finance sector can play a role in facilitating this transformative process by doing more to address sustainability and the social impact of investing. So Gerald, let's start by talking about and defining what sustainable finance is.
Sure, Steve. That's actually a very good question to start because I think it's important to know what we are talking about. So sustainable finance, also sometimes coming across in the acronym of ESG, it's about financial transactions that contribute to one or more of the dimensions that's behind the acronym of ESG. So that's E for environment, S for social, and G for governance. It's quite important to sort of have a clear distinction between sustainable finance and philanthropy. So we are not talking about charity here. We're not talking about the corporate social responsibility activities of companies. We are talking about the business, about financing that would contribute to either environmental goals, where climate change, I guess, is the most sort of prominent issue at the moment, to social goals, where the biggest areas that usually come about when thinking about is areas like healthcare, education, equality, and governance, where people usually think about the way of setup of companies, or also the question to avoid things like corruption or crime. This, I would say, is broadly how ESG is being defined of sustainable finance. It's important to understand that it's actually product agnostic. So when we talk about sustainable finance, we are not limited to either bonds or loans or equity. We talk about sort of any financial transactional product with this distinct idea to contribute to the goals that's behind ESG.
And Gerald, who are the actors then that can create an environment for sustainable practices in general? I mean, if it's not just corporate philanthropy, corporate social responsibility, but more than that, who are the different players that one needs to keep in mind?
So when we think about the sort of the people on the playing field of sustainable finance, then we have various stakeholder groups. We have obviously banks being providers of financing. We have investors, again, being providers of capital and financing. We have companies that need financing or would like to attract investment. And then we have the whole sort of state, which I would describe as rule setters, standard setters, and regulators. And on the other hand, we have the civil society, which is the society at large, and also the sort of a special ESG society, which includes NGOs. So as you can see, it's quite a broad sort of stakeholder field that we're operating in.
And what is the German take on sustainable finance? What makes sort of your approach, Deutsche Bank's approach, distinctly German?
So, and this is not something that I think grew kind of in my head after having been on the committee for now nearly 2 years. And some of the things that I will just describe are pretty, I think, clear then or logical for those people that know Germany, because Germany is a couple of specifics that sort of make the country what it is. It's an industrial country, so stuff is being produced here. It's a country that is a federal country, so not every power is concentrated in sort of one central administration. It's spread out. It has an economic system that sometimes is described as social capitalism. It has a very unique economic infrastructure by having these mostly family-owned mid-cap companies or Mittelstand being the backbone to it, the economy. And also, it's a country where the state has some sort of role in the financial markets. We have state-owned banks over here. We have state-owned agencies over here that play a large role, like KfW, for example, that might be known to some in the audience. And it's generally a country that is quite good when focusing on substance and technical details. It's not necessarily a country that's specializing in PR. So all of this, I think, lays the groundwork for the couple of elements that I will describe briefly, what makes sustainable finance in Germany a little bit special. So first of all, Germany views sustainable finance as a holistic concept. So it's E for environment, but also the S has quite some focus in Germany. Questions like working conditions, education, healthcare, all of this also plays a role here in the ESG discussion, maybe more than in some other marketplaces that I've looked at. Secondly, the focus of sustainable finance in Germany is the transformation of the real economy, because it's an industrial country. And it's about transformation of the economy and not abolition of industries. And the financial sector accordingly is seen as a partner, as an enabler, but is not the main focus area in itself. This also leads to the next one, which I think makes it quite special here. The focus in Germany is less on products if you compare it to some other financial sectors, but again, more on the transformation effects. Also, Germany is interested in global rules. So Germany, as I guess most of you will have realized over the last couple of years, is quite sort of committed to multilateralism and is quite committed to the idea that global level playing field should be achieved wherever possible. This is not only to sort of for the sake of global rules, but also to make sure that competitiveness is maintained and that the country has no distortion, especially when it comes to the big economic blocs, EU, China, and the United States. As I said already, the Mittelstand is quite important, which means that the question of sort of applicability of rules and proportionality of rules is a big topic here. So there is no sort of idea to apply the same rules that apply to big corporates to every sort of size of corporates. There is a clear focus on ensuring that the rules that are being written and the standards are applicable and are actually being suitable for all sizes of companies, for the smaller ones as well. And then maybe as a last point, and I know I talked a lot now in this one question, but that was maybe the question I sort of prepared most for. It's a country that is also quite focused on reporting rules and on quantitative metrics. And I think that's something which is hugely important for the next phase globally. We need to move this whole sustainable finance debate out of qualitative discussion into numbers. Because if we would like to grow markets, we always need transparency and standardization. That's the prerequisites for scaling up sustainable finance. So Germany is quite focused on that area as well.
Thanks. I mean, I think that this overview helps really set the stage for our conversation. And there are at least a couple of points I'd like to maybe hone in on and ask some follow-up questions about before we get into the report and the recommendations by the committee itself. And the first one is, and you started to talk to this about this a little bit, the role of the Mittelstand, the role of small and medium-sized enterprises. I think anybody that knows a little bit about the German economy knows that in many senses, the Mittelstand build the backbone of the German economy. But there are also some very large multinational companies that have their roots in Germany, or even one could say German companies that are globally active and globally engaged. As you think about sustainable finance and sustainable structures for industry, for business, for manufacturing, is there a huge distinction between the way in which some of those small Mittelstand companies are treated or how they approach this and the large ones, or is there much more commonality between the two kinds of organizations?
So I would say the conventional wisdom would always be to say that there's huge differences, but in essence, there's not, right? The one area where there is differentiation needed is, as I said, when reporting requirements or any other regulatory requirements are being implemented, that we always need to make sure that we are not overburdening the smaller companies so we can take them with us on the journey. When it comes to engagement, it's actually quite interesting that the mid-cap companies, so traditional Mittelstand, is actually far more advanced than people would give it credit for, and is doing quite a lot in this field. Given ESG or sustainability generally, for me, is next to digitalization, one of the two mega trends that we are facing at the moment. This hasn't been lost on owners of middle-sized companies. They are usually market leaders in some very specialized niche, and so they're investing quite some time into thinking about how they can stay ahead of the game in terms of answering to this trend of more sustainability requirements. What is true though is that when it comes to financing or financial products, then of course the smaller the company is, the less sophistication might be there in terms of the products that are being used, and maybe the sort of more pre-packaging or more general sort of offering must be there for these smaller companies when we as bank or capital markets providers think about it. But generally, I would say the differences are less so. So that's why I would always encourage also the United States, as well, as far as I see from the distance, also has some pretty lively mid-sized company scene, to take these guys with us on the journey, because otherwise it will be pretty grim for the globe if we're only taking the large corporations with us.
Thank you for that, because I think that also sets the stage for the next question I wanted to ask you, because you talked about sustainable finance focusing sort of less on products and more on transformation. And when I think about transformation, I think about things like Strukturwandel, structural change, the way in which regional economies have to change and adapt. We've seen this obviously most recently in Eastern Germany, in the Neue Bundesländer, as they've made this incredible transformation, but it's also been a ongoing narrative for places like North Rhine-Westphalia and other areas as well. To what degree does this sort of transformative process, or does specifically structural change, factor into sort of the deliberations that one has when one thinks about sustainable finance?
I think that the basis at the moment when people use the word transformation is mostly around decarbonization, because we have public commitments by various countries around the world and increasingly various companies around the world to decarbonize mostly over a time period between 2040 and 2050. So that's the sort of the commitment or the goal towards these companies are operating. So where does finance come in here? I think sustainable finance can, with the products that are being offered, help in two ways. One is when a company sort of enters a sustainable finance transaction, then the company shows more commitment to the topic because it's a legally binding financial transaction than maybe a company would show when just talking about it in a PR sort of sense. Because if you as a company enter into a financing that's linked to certain environmental KPIs, or where you promise the use of the proceeds that you raise for certain projects, then you need to do a couple of things in your own company to make sure that you can actually fulfill the sort of the rules or terms of the financing. You need to define what's sustainable or green for me as a company. So you need some sort of a taxonomy or definition, which of course requires quite some work and deliberation in your own company. Then usually you need to set a governance, like who decides what can qualify for the financing or what doesn't. You need to sort of track the funds and make sure, if there are KPIs involved, that you kind of check the metrics of how the performance of the company is versus those promises. And then finally, but maybe most importantly, the market is by now expecting some quite specific reporting about the impact of a sustainable finance transaction. So those companies that do it, whether they issued a green bond or whether they issued a sustainably linked loan, they have to publish a sort of an impact report talking to the outside world about what has the impact been. And you can imagine that all of those sort of endeavors truly change the way of how big corporate management is looking about these things. It is truly, I think, putting ESG to the heart of the strategy and outside of the PR sort of routine. I think that's one thing. And then, just because it's transformation, there is a very distinct but rapidly growing field of products that we would call ESG linked products. It's a product which is not like a green bond promising to use the proceeds for certain projects, but it is linking the cost of financing to how you fulfill a certain journey or path of metrics that you promise to the market. The most tangible example is, again, decarbonization. So companies would promise a certain decarbonization path over the next 30 years. And as long as the financing is out there, people will check whether the company fulfilled its milestones. If it has, it gets some coupon rebate. If it is not fulfilling the milestones, it has to pay a penalty. And that, I think, is a very clear link of decarbonization transformation to financial products, which shows, I think, very tangibly how these products can work.
Thank you. As I mentioned at the outset, late last month, the Sustainable Finance Committee that you sit on released a report with more than 30 policy recommendations to really try to strengthen the sustainable financial system and infrastructure. Can you maybe share with us what some of the key recommendations were, and who needs to be involved in making those recommendations happen, making them into a reality?
So the report covers 5 different areas, and without going too much into detail, I would like maybe to focus on the 2 most important ones, because the other ones that are in there are all important, but I think 2 really stand out in terms of significance. The first one is calling for a very sort of coherent role of the state in the discussion. And this is important because the state obviously has 2 roles. On the one hand, the state sets rules, and carbon pricing, for example, is one of the most obvious things that governments have to get their heads around. But the state also plays a significant role in the capital markets as either an issuer or an investor, and can actually act as a role model. So in this area of role of the state, there have been quite some recommendations in the report calling for the Federal Republic's investment portfolios to be aligned with principles of responsible investing, which is a United Nations principle, of actually building in all German government's climate and ESG commitments into the investment rules for all of those portfolios. It's about the issuing activity of Germany and all the German regional entities in the capital markets. You might have seen that Germany last year issued a green bond, so a green government bond for the first time. Questions like this: how often should this be done? How should the products look like? And how should the German bond use its Eurozone benchmark issuance status to further promote liquidity in green bonds? That was one thing. And then the question also came up, typically German, about the role of the state banking sector. Like, how aligned should sort of the reasons for why we have savings banks and why we have public banks, which are all sort of committed to the broader good of society, how should that actually fit into the debate? So first recommendation set that I would highlight is the role of the state. The second one is company reporting. And that sounds technical, but as I said before, this is hugely important, because without transparency and standardization and numbers, metrics, it will be super difficult for capital markets to really reach the scale that we need to finance the transformation of the economy. And so there is a whole set of very specific recommendations to say, look, we need to make this a standardized reporting which is integrated into financial reporting. Because at the moment, if you look up a sustainability report of any American or German company, it's a shiny, glossy report full of words, different format in every company. And any analyst that would like to look into it is really lost, because you don't know where to find it, and you don't know how it compares to others. So this question of a standardized, integrated reporting is hugely important, including the recommendation that these reports should also be audited like financial reporting, so that we get some standardization and reliability in. The other thing I would like to highlight, which is neatly hidden in the middle of the report, we did an attempt to sort of recommend base metrics that should be valid for all industrial sectors, to sort of start the debate of which specific numbers would actually be the sort of the role model for company reporting. Similarly to those of us working at banks, we had to get used to questions like what's a leverage ratio, what's risk-weighted assets, what's a net stable funding ratio, what's a liquidity coverage ratio. So in the report, we asked for a couple of metrics. It's about carbon, water usage, land usage, supply chain compliance. It's about a couple of social metrics and a couple of governance metrics that we propose to sort of form a skeleton for potentially global alignment around a couple of metrics. Because the discussion at the moment is truly suffering from the fact that we have many standard setters, mostly private initiatives that come out of the ground nearly every week, and that most of these ideas are qualitative. And if we have standard setters that propose metrics, then it's many, it's hundreds. So the idea was to say, let us maybe, tone it down a bit to something that is digestible for the human mind, so that we can give some guidance of how this focused reporting might look in the future.
Thank you, Gerald. I wanted to ask you about the company reporting piece, because as I looked through the report, one thing that I did notice was that about a third of the recommendations, of the 31 recommendations, have to do with reporting and trying to create greater transparency when it comes to reporting, both on the part of the private sector, but also in terms of the finance sector. So both for business and for finance. But I found what you were saying about the metrics to be particularly interesting, and your comment at the end about the importance of global alignment, because there are many different standard setters. And so one of the questions that I have is to what degree is this work of the German Sustainable Finance Committee tied into a broader framework? To what degree are you thinking about metrics, standards that aren't just relevant for Germany, but indeed for Europe, for the EU, but even on a more global level?
So the whole idea of the report was to basically have as global recommendations as possible. So a couple of areas, including company reporting, should be seen as global recommendations, some for the European Union, and where only there is no global alignment possible or European Union alignment, for German implementation. And especially on company reporting, I would still expect and hope for a global standard, because you can see that the IASB, the foundation setting the international financial reporting standards, has only this year announced that they would look into creating such a global standard. We've seen that in the United States, the SEC came out saying that they are reviewing ESG company reporting requirements, and also mentioning in a speech the IASB endeavors. So for me, this would actually be a true chance of sort of transatlantic cooperation to make sure that whatever is created here is as global as possible. And there are many initiatives at the EU level looking into this. We have a big thing called NFRD, Non-Financial Reporting Directive, which is the sort of the base rule in the European Union for these topics, which is being reviewed at the moment. So it's just being basically started in a new way again. Then we have these developments in the United States, and we have the IASB looking to harmonize, plus a couple of other sort of communities like the World Economic Forum having tried to contribute to the discussion. So I think it's definitely worthwhile for everybody who is involved in this sort of sphere of either company reporting or capital markets or standard setting to try to fight to make this a global standard, because that will be the best, I guess, for the topic, for scaling up sustainable finance, and then in the end for making sure that investments are channeled into the right projects to fight climate change or inequality or any other thing.
So, Gerald, how has the report and its recommendations been received? And if there were any, sort of which of the recommendations were the ones that were the least well received, or might be perceived as being the most difficult to implement?
So, as always, the recommendations were a compromise. The committee itself is 40 people from all sort of stakeholder groups. So it's banks, insurers, investors, corporations, it's regulators, NGOs, science. So everybody basically that has a role in discussion was represented there. So as you can imagine, some people wanted to go more far, others thought that it's already too far. The one criticism that maybe was there and is always there when we talk about sustainable finance is this sort of idea that this is a bureaucracy monster that is being created. And that's something which I think is quite important to sort of talk about. Because for me, we're not talking about creating a bureaucracy monster. We are talking about giving some sort of definition and frame to a trend that is happening at record speed in front of our eyes. So for me, it's more about if you as a company would like to be globally competitive or even regionally competitive or even survive, you need to take this seriously because consumer preferences are changing, investor preferences are changing even quicker than consumer preferences are changing. And the sort of public attention and the way that many, many trends that we have seen are coming together just really increase the pressure on the economy. So I'm saying this is not creating a bureaucratic monster. This is trying to give some tools to the wider economy to keep their access to financing, to keep their access to investments, and to make sure that innovation and job creation can happen. So I think that's the one thing that I would say. If there's one area that I would have personally wanted the report to go further, it's about the regulatory regime for banks, which in Germany is quite a hotly debated topic. So Germany is not really a fan of using prudential regulation for incentivation of any other thing than financial safety. But I think it's fair to have a discussion, hopefully at Basel level, about how bank regulation should actually look like in the field of sustainable finance. Now, a lot of people would say politics and regulation should be completely separate. But I think the reality that we face is that regulation is always political. Just remind ourselves that government bonds have no risk weighting at the moment. Just reminding ourselves that there are specialties all around the world in how Basel III has been implemented in terms of making sure that it fits with the wider economic sort of goals of the country where it's been implemented. So I think it's still a fair debate to be had about what bank regulation or capital markets regulation should contribute in terms of making sure that funds or general money is poured into the right project. And when you see the global discussion that's happening at central bank level, you can see snippets and bits and pieces of central bank debates that are firmly around that. You can always hear this when the ECB is talking about reviewing its mandate, news about thinking about greening the economy come up here and there, and then the critics come out and the proponents come out. Same is true for the Bank of England, that is being given a wider mandate now to also look into climate change as one of the policy goals. So I think it's an area that will not go away, that is hugely sort of emotional. There's no discussion about sustainable finance with banks and regulators where this topic isn't coming up. So I think it's definitely worth to keep in mind. And this was the one area where I felt we could have done more in the report, but it was not possible to get sort of a compromise around this topic.
Mm-hmm. Thank you for that. I'd like to sort of come back to the first part of your response where you reminded us all about sort of the overarching trends and the rapid pace of change that we're all experiencing, and the necessity to establish some standards and some norms and guidelines to manage that change, but really also to think about the future and to put sustainability first. Of course, much of the work of the committee over the last 12 months or so happened against the backdrop of the COVID-19 pandemic. And so, many of us have observed that the pandemic has exacerbated some of the social inequities that existed previously. It's increased awareness about those social inequities. It's increased awareness about environmental topics as well. To what degree did the pandemic sort of play into the deliberations of the group and actually influence some of the policy recommendations that you made?
That's a very interesting point, Steve, that you make here, because when the pandemic broke out last year, there was some sort of brief period of time where the view was there was the dominant view that this would now sort of push back ESG as a matter of priority, because it's all about liquidity and about making sure that companies don't go bust. But then the opposite truly happened. And I think in Europe in particular, we can see this in all sorts of areas. We can see it in the area of environmental policy, where the recovery packages and the European Green Deal were clearly linked to climate change and to other environmental sort of topics in a much more direct way than we might have seen without the pandemic. So it actually had the opposite effect to link some big state programs directly to this topic. So I think that's the first one. The second one, and that's I guess a global phenomenon that I also observe in the US, is that the whole discussion, and you already mentioned it, about the S in ESG, the social element, just became much more important. And I have to say, I also was a little bit changed in my view around this when we started the committee work in 2019, and we were sitting down. I was one of those people to say, look, the climate topic is so important. Let's talk about green finance. And there were many people, including, interestingly, the Ministry for the Environment in Germany, that kept saying, no, this has to be holistic. We need to think about the social element. And I thought, like, well, Germany with the social welfare state, what are these guys talking about? We need to think about the climate policy first. And then the pandemic hit, and we suddenly realized how interconnected these things are, and that we cannot fight for a decarbonization that leaves society behind. Communities have to thrive. People have to have a good living, a good earning. We need to take care of people that might need different jobs in case certain industries might not have a viable future. So I think this sort of prominence of S in ESG definitely was an effect of the crisis. And then I think the third thing, which is a little bit more difficult to describe, but I think we all see this, is that the pandemic has some sort of, I think, accelerated the whole, and I would describe it as maybe the whole millennial debate in the economy. So I think it has accelerated the outspokenness of a younger generation in many areas. It has accelerated the way that social media influences our economic behavior. When we just think about the GameStop saga and things, I think this also has a little bit to do with the effect that a lot of people are in lockdown, don't really have things that they would usually be doing. So I think this new sort of intensity of people questioning sustainability in a broader sense, resilience of lifestyles, of models, questioning economic models, also is playing into this debate in quite a big way. So when we worked on the report, again, the social element just became more prominent than we thought it would be. And this whole question how sustainable finance might actually sort of play together with some of these other forces that we are seeing also became more prominent. So I have to say it was quite an interesting experience.
Thank you. Before we come to this side of the Atlantic, and I ask you some questions about sustainable finance in the US, we have a viewer question, and I'd like to remind our viewers that if you have a question, you can raise your hand. You can also submit your question using the Q&A function or the chat function. But I'd like to invite Joe McLaughlin to pose his question. Joe, if you could introduce yourself.
Dr. Podobnik, thank you very much for your remarks. They're very informative. There's a question in my mind about the connection between the reporting recommendations and a company's access to finance. In the United States, of course, if a company does not comply with SEC reporting requirements, it cannot access the public markets. But does the report contemplate that a company will lose access to capital markets and or bank financing if it does not comply with reporting recommendations?
So the way that reporting requirements work over here in the non-financial reporting space is regarding company size. So at the moment, every company that has more than 500 employees plus has listed instruments on the capital market. So it's either equity is listed or has bonds listed, is required already to sort of publish a non-financial report. But the problem at the moment is that the rule just says publish a non-financial report and doesn't really give you exact requirements of how this report should look and what it should contain. And that's the first recommendation that we said, look, we need to tell people what they should include here, especially quantitatively, and not just say, write a report. The second thing is that we recommended to lower the bar of when you are required as a company to have such a report. So we propose that every company that has more than 250 employees, irrespective of whether it has listed instruments on the capital market, should be required to draw up such a report and publish it. So I think to answer your question then more directly, if this recommendation would be implemented, a company that has more than 250 employees would have to publish this report. Otherwise, they would be in breach of the reporting requirement. Now, what we said as well is, because those companies might not have the same resources at disposal than larger companies, that their reporting requirement is less stringent, so easier to fulfill. And we're also calling for a German or if possible European sort of raw database where everybody can get free of charge certain base data that would help them to ensure that they can fulfill their reporting requirements.
Thank you. So in recent weeks, there's been a fair amount of reporting on the Biden administration and on some of the strides that have been made in sustainable investment, including the administration's renewed commitment to address climate change. The return to the Paris Agreement was cited pretty frequently in some of the reports that I saw. In your opinion, how is the approach to sustainable finance different in the United States from what you've been talking about so far about Germany?
So when looking at the United States, I think I have to structure my answer in a couple of buckets. So first of all, in Europe, there was sort of the view up until the Biden administration that the US is absent. I was never of that view because we have seen that the United States, obviously being a huge country with different stakeholder groups and different organizational entities, always was a player, whether it was big investors like BlackRock, whether it was states like California with its emission trading scheme, or whether it was companies from everywhere in the US, but maybe mostly prominent here in Europe, what Silicon Valley is doing with some of its sustainability policies and also some of its sustainability transactions in the financial market. So I never was of the view that the US was absent. I think what has changed with the Biden administration is that the federal authorities are much more active in the discussion, and we can see that nearly anywhere. I already mentioned the SEC deliberations about potentially changing company reporting requirements. We see the Fed thinking about climate risk as risks to the banking system. We see that the Fed is joining a club called the NGFS, which is the Network for Greening the Financial System. It's a central bank and supervisor club that was set up a couple of years ago that I think by now has most of the globe's central banks in there, where the Fed was still missing and is now part. And we see some truly, I would say, increased also dialogue or questions or interest by various state regulators in various sectors in the US. So I think this sort of federal government level and sort of state regulatory level outside some states that were already really on it, like California, has really changed. And so in Europe at the moment, I would say people are a little bit, I would say they are full of respect for this change, maybe a little bit fearful because Europe enjoyed its pioneer role and is now, I think, expecting some sort of a warp speed US turning on its machinery on the topic. So there is lots of, I think, interest from this side of the Atlantic on cooperation with the US and on exchanging views early on, because the expectation is that the sort of topic will be just treated with utmost priority by the various stakeholders in the US. When it comes to thinking about the approach, I would say that the approach is pretty similar, at least from what I can see. Naturally, the US has interest in rules that are globally comparable. Naturally, the US has interest in the transformation of the real economy, being a country with a huge industrial sector as well. Clearly, the US is interested in a holistic view especially with the inequality and diversity debate that is so prominent in your country. And I would say that some of the themes that we have in Germany, which I didn't mention so far, some of the new ecosystems that are emerging, we have seen similar interest in the US. So at the moment, there are big ecosystems evolving over here, like electric transport, like hydrogen as an energy source, like supply chain compliance, so that companies are not only responsible for their own products, but also to procure sort of input products from sustainable supply chain providers. These are all topics that resonate, at least in my observation, in the United States as well. So I would assume that the discussion will be similar. Products are important here as well as in the US, but I do not see the US going down the route of some of, say, the more finance-only countries in Europe that only talk about green bonds when they mean sustainable finance. I would think the US will take a more structured approach with real economy transformation in mind as well. So I think the similarities are definitely there.
Thank you. You know, we had sort of teed up the title for this event when we spoke a couple of weeks ago, looking at whether or not Germany and the United States are partners or rivals when it comes to ESG. And from everything that you've said, without sort of coming out and directly saying it, it seems as if there's much more common ground between Germany and the US to strengthen the partnership than really a rivalry in this regard. Would you say that that's true? And where is there low-hanging fruit, if you will? Where are there sort of easy wins for collaboration when it comes to creating a new framework or finding common ground?
So I would agree, Steve, that this is true. I think there are two areas potentially that would stand out as important. I think the first one is, obviously, the US with this capital markets-based financing system has a huge amount of investment money. So I think this question about how to make sure that the right projects are finding the right financing from both sides of the Atlantic is hugely important. So that's maybe the first area, cooperation in the area of investment. The second one is, and this is something that when John Kerry visited Europe already came up, is this question about cooperating on the global taxonomy. So the European Union at the moment is drawing up a sustainable finance taxonomy, which gives some definition guidelines of what could be considered sustainable. So you need to imagine this is like a big book of technical standards that says, for example, renewable energy is sustainable if it does the following things and if it avoids the following bad things. Like you wouldn't want to build a solar park in a sort of a national park. You wouldn't want to build a solar park where the solar panels are procured where there are human rights abuses. So these sort of definition guidelines. There's usually quite some criticism about the EU taxonomy being very detailed and very technical, but I have to defend it a little bit here because it's not meant to be a sort of a stringent requirement for everybody to apply all elements. It's more of a sort of a voluntary comply or explain rule where you can take the detail level that you would want or explain why you don't use it otherwise. I think on a broad sort of taxonomy topic, to get some alignment between the United States and Europe would be important because it just helps all the investment money out there to get their heads around of where they would sort of avoid the trap that is usually called greenwashing, where people would say, oh, you had best intentions, but you basically finance just somebody that wants to do a PR gag and actually hide their very poor sustainability credentials. And for us as a financial sector to have a little bit more certainty and understand where is a safe space, I find the taxonomy actually a good idea. Now, there are always discussions then about sort of the fringes. So in Europe at the moment, there's a huge debate whether natural gas can be sustainable. Germany is saying yes, it's much, much less problematic for the carbon emissions than coal. Others are saying no. I'm not actually too fussed about this. I say, look, let's have a debate about what are sort of the broad sort of concepts that people can get their heads around. This alone will take a lot of sort of headache out of the industry. And I think this sort of idea that potentially there could be some sort of a global-based taxonomy would actually be quite a good investment of effort.
Thank you. We actually have a question from one of our viewers who happens to be in Germany and the alumnus of one of our fellowship programs that focuses on finance. He writes, how would you measure the impact of universal investors who are focusing on sustainability as they see it as a material risk for their ability or for the ability of enterprises to produce profits over the long term?
So usually, I think I would like to answer this question maybe in sort of two dimensions. The risk that the gentleman is describing, we call transition risk. So it's the risk that because of climate change, because of sustainability, whole industries might have no viable future and go out of business. And how this is usually being measured, there are various scenario analysis tools available that usually go back to some international energy agency scenarios and actually try to say if the following temperature changes happen and the following policy changes happen, this will happen to the profits of those industries. So we have these matrices that at the moment regulators around the world are thinking of how they would include those scenario analysis results in stress tests. So the Bank of England is doing one, the ECB is doing one. There are discussions, as I said already, on the US side about how this climate risk topic could be integrated into risk management. So this will happen, and it will be based on scenario analysis, where again, the jury is out there on harmonizing the scenarios, but the tools, they are there. I think that's one thing. If we talk about the impact measurement of investments, so the other side, like what is the positive impact of an investment, it's also the same answer, that there are various tools being developed. They are usually at the moment models-based because there is not enough company data available, but this will change when the reporting requirements become more stringent. And so over the next couple of years, a sort of a base data set will develop where people will be able to get their heads around, like, what are they contributing to carbon reduction? What are they contributing to less water usage? What are they contributing to less or better land usage? What are they contributing to pay equality and these sort of things? So that's all a whole new sort of service industry that's developing at the moment, trying to come up with the right models. And then in the future, hopefully, with more company data, ever bringing those model sort of results closer to actual company-based reality.
Thank you. As a follow-up, the same viewer wanted to push you a little bit on your thoughts about how to align European and US approaches on sustainable finance. And he asks whether the adoption of SASB standards would be a useful approach. Those are standards set by the Sustainability Accounting Standards Board.
So SASB is one of, it's very important, and it's one of the many standard setters that's out there. I think I would be surprised if it would just be one standard being sort of applied globally that already exists. So I would assume more that standard setters like the IASB will take, I would say, the best, at least what they see, of all standards, including SASB, to potentially sort of write something newer, more comprehensive, that potentially takes in other standards as well. I think one very good guide that I like a lot, if you take a look at the World Economic Forum had an initiative that last year published a sort of a report taking what they consider to be the most relevant standards from SASB, from GRI, the Global Reporting Initiative, and from other standard setters that are out there, and try to harmonize this. So I think for those interested in how this might look, I have the report somewhere here. They might be able to look this up. It was called Toward Common Metrics and Consistent Reporting of Sustainable Value Creation. I like that one. That's good reading.
Thank you. Thanks very much. Sticking with the sort of alignment of US and European and specifically German policy, another viewer asks what the best forum might be to develop common ESG guidelines. Is it just through transatlantic dialogue? Is it through the OECD? Is there another forum that you think would lend itself to greater discussion between Europe and the United States and really the laying down of policies?
I think one framework that could be used if we think about global policy making would be all the activities around the COP26 preparation. So that's a climate conference that will happen in Glasgow in November. So that could be used. Another one obviously would be bilateral discussions between American and German groupings, which I think would be a sort of a good investment, especially at this early stage of discussions.
Thank you. And I have one more viewer question. Let me just pull that up. One of the report's recommendations is to establish for institutional investors a, quote, reliable legal basis for ESG engagement, end quote. Does this mean legal protection against liabilities for investing for reasons other than the best risk-adjusted investment return?
Not totally. So this is, I think, a discussion that is maybe different in the United States because I guess you guys are more advanced. It's about the question of stewardship and engagement models that actually allowed. So in Europe, there's very strict rules on what investors can do when they would like to join up and have an engagement with a company. That could be seen as collusion, and it's very, very rigid what they can actually do and cannot do. So this calls for a potential sort of revision of the stewardship model to include what you just said, some sort of other interests as just purely financial returns as well, but also to allow that there is more, I would say, exchange of views between investors on particular issues and more active engagement with companies.
Well, Gerald, I want to thank you for spending the last hour with us. This has been a great discussion. I think we've covered a lot of ground, and it sounds as though there really are a lot of opportunities for specifically Germany, but Europe writ large and the United States to develop some guidelines and standards for sustainable finance moving forward. And particularly, I think, as we all start to come out of the pandemic, as you said earlier, climate and climate issues will be top of the agenda as we experience sort of a recovery from the public health crisis and also from the economic crisis. And I'm sure that will bleed into the way in which business decisions are made and also finance decisions are made. So I'd certainly like to thank you for sharing your thoughts with us and for sharing the report with us, and look forward to continuing the conversation in the months ahead, because obviously these topics are not going to disappear, but will be issues that we will be addressing for months, if not years to come.
Yeah, thank you as well for having me, Steve. Thanks for the questions. Also, thanks to the audience for listening on a Friday morning and for asking the interesting questions as well. It's a topic that's always great to discuss. It's, as I said, one of the mega trends that we are facing as society. So I'm always grateful to have such an interesting exchange. Thank you very much.